Warren Buffett's investing strategy isn't just about picking stocks, it's a science, an art, and a mindset all rolled into one. While most people know he's a billionaire, what they don't know is how he built his empire by sticking to a simple set of principles that have made him one of the richest men in the world. Did you know that if you had invested just $1,000 in Buffett's company, Berkshire Hathaway, in 1965, it would be worth over $28 million today? That's a return of about 2,800,000%. It sounds unbelievable, but it's true. In this video, we're going to reveal the truth behind Buffett's success. We'll look at the hidden habits that set him apart from everyone else, the principles that guide his decisions, and the psychology that helps him win when others fail. We'll also dive into the things Buffett does differently that most investors overlook. This is not your average Buffett breakdown. We're going beyond the clichés and revealing the real reasons he's been able to consistently crush the market for decades. Stick around, because by the end of this video, you'll have a clear picture of how Warren Buffett thinks, and how you can use his strategies to make smarter investments yourself. Chapter 1. Beyond the Billionaire Persona. The hidden habits that shape Buffett's strategy. Warren Buffett, the Oracle of Omaha, isn't just famous for his billions. His daily habits are crucial to his investment genius. Buffett's day starts early. He reads 5 to 6 hours every day, focusing on newspapers, books, and financial reports. It's said that his secret is simple: the more you learn, the more you earn. Buffett's relentless learning gives him an edge in identifying market trends before others. But his habits go beyond reading. Buffett spends hours reflecting and thinking about his investments. He believes that patience and focus are the keys to understanding complex financials. He famously said, "The stock market is a device for transferring money from the impatient to the patient." Additionally, Buffett invests only in businesses he understands. He calls this his circle of competence. This strategy stops him from chasing trends. Instead, he focuses on industries and companies that align with his knowledge. In fact, he's only invested in a few sectors, including insurance, banking, and consumer goods, because these are areas he fully grasps. When Buffett meets with potential business partners, he keeps things simple. He's known for being an excellent listener, letting others talk more. This habit helps him gather information he might not have considered. After all, as Buffett once said, it's better to sit on your hands than to jump into the wrong investment. Chapter 2. The 5 secret principles behind Buffett's success. That no one talks about. Buffett's method is more than just buying stocks. It's about mastering a set of principles. Here are 5 that aren't commonly discussed but are crucial to his success. First, Buffett focuses on economic moats. This concept refers to a company's ability to protect itself from competition. For example, Coca-Cola's global brand recognition and distribution network give it a competitive advantage that's tough to replicate. Buffett always looks for companies with a wide moat, ensuring they can thrive for decades. Second, Buffett emphasizes the power of intrinsic value. He doesn't care about market prices. Instead, he calculates a company's true worth based on its future earnings. This approach ensures that he buys stocks at a discount compared to their true value. For example, when Buffett bought Geico in 1976, its market price was far below its intrinsic value, making it a great bargain. Third, Buffett prioritizes owner's earnings, cash flow that's generated after necessary capital expenditures. This metric, not just profit, is how he measures a company's financial health. This helps him avoid companies that appear profitable but lack the cash flow to grow or withstand tough times. Fourth, Buffett avoids short-term speculation. He sticks to companies that he can hold indefinitely. He's noted, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This long-term mindset is rare in today's fast-paced market but has been key to Buffett's success. Finally, Buffett believes in the margin of safety. This principle is about buying stocks at prices well below their intrinsic value, allowing room for mistakes. By ensuring this buffer, Buffett reduces risk and maximizes the potential for returns. Chapter 3. Buffett's psychological edge. How he thinks like a chess grandmaster. One of Buffett's most valuable traits is his ability to think strategically. He's often compared to a chess grandmaster, constantly considering his next few moves. This mental agility helps him make long-term decisions that others can't see. Buffett is known for his delayed gratification. While many investors rush to make quick profits, Buffett waits for the right opportunities. He's patient, willing to pass on many deals because he knows they don't fit his criteria. He once said, "We don't have to be smarter than the next guy, we just have to be smarter than the crowd." Buffett's strategic thinking is also influenced by his risk management approach. He believes in staying within your circle of competence. Just as a chess player wouldn't attempt moves outside their skill level, Buffett avoids companies and industries he doesn't understand. This cautious approach helps him avoid unnecessary losses. Moreover, Buffett's strategy is rooted in his opportunistic mindset. When others are scared, he's often buying. During the 2008 financial crisis, Buffett invested heavily when stock prices were plummeting. His famous quote, "Be fearful when others are greedy and greedy when others are fearful," became a guiding principle for value investors worldwide. Buffett's success is also due to his focus on long-term competitive advantage. Like a chess grandmaster planning several moves ahead, Buffett looks for companies that can sustain growth over decades. This perspective allows him to hold investments through market ups and downs, knowing that his strategy will pay off in the end. Chapter 4. The one metric that could change your investment game. Buffett's secret weapon isn't just finding great companies, it's understanding the return on equity, ROE. ROE is the percentage of profit a company generates with shareholders' equity. Buffett has said that ROE is the best indicator of a company's quality. What makes ROE powerful is its simplicity. A company with a high ROE is efficient at generating profits, which means it's likely to reinvest those profits to fuel future growth. Over time, Buffett has consistently favored companies with a high and stable ROE, as it signals strong management and business fundamentals. In fact, Buffett even used ROE as a primary factor when evaluating companies like Coca-Cola and American Express. He doesn't just look at short-term profits, he analyzes how effectively a company can turn its equity into long-term wealth. This mindset is why his portfolio includes timeless brands with consistently high ROE. Interestingly, Buffett also values predictability. He wants companies that have a clear and consistent track record of earnings. If a company can produce steady returns over many years, it becomes a dependable source of wealth. This is why he's often avoided tech stocks, which can be volatile and unpredictable, despite their appeal in the market. Chapter 5. Warren Buffett and the power of compounding. It's not just about the number. Buffett is a master at compounding, but he doesn't just think about it in terms of numbers. To him, compounding is about time and patience. The longer you hold onto a great investment, the more you benefit from its growth. He often uses compound interest as his favorite tool for creating wealth. It's not just about putting your money in a stock and hoping for the best, it's about reinvesting your earnings to grow exponentially. In fact, Buffett once said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." But compounding isn't just about financials, it's about finding companies that reinvest their profits wisely. Buffett looks for businesses that use their earnings to grow the business, pay dividends, or buy back shares. These strategies compound value over time and are critical to Buffett's approach. For example, his investment in Berkshire Hathaway itself is a testament to compounding. The company's book value per share has grown from $19 in 1965 to over $300,000 in recent years. This growth came not just from reinvestment but also from Buffett's ability to choose high-quality companies with strong compounding potential. Chapter 6. The dark side of Buffett's method. What's missing from the Buffett secret? While Buffett's method has made him a legend, it's not without its flaws. One of the biggest critiques of his approach is its dependence on market timing. Buffett has always been strategic about when to buy and sell, but the market has changed in ways that make this harder to predict. For example, Buffett has missed out on opportunities in industries like technology. He famously avoided investing in Apple in its early years, which cost him billions in potential returns. While he's admitted to his mistakes, his preference for traditional, slow-growing industries has limited his exposure to certain high-growth sectors. Another limitation is that Buffett's strategy works best with large amounts of capital. For individual investors with smaller portfolios, it can be difficult to replicate his approach. Buying entire companies or large shares of stocks requires significant resources, which the average person doesn't have. Additionally, Buffett's focus on large, established companies sometimes leaves out opportunities in emerging markets or smaller companies with huge growth potential. His method works well for stable, predictable companies but can miss out on the kind of exponential growth that younger or riskier companies can offer. Despite these drawbacks, Buffett's ability to adapt and learn from his mistakes has kept him at the top. His method might not be perfect for every investor, but it's undeniably one of the most successful strategies ever employed. Don't forget to subscribe if you want to dive deeper into Warren Buffett's world of investing, explore more strategies, and start applying them to your own portfolio.